Why are my stop-loss orders too tight or too wide? Imagine trying to protect your savings from sudden market drops, but your safety net keeps catching you too soon or not soon enough. That's what happens when your stop-loss orders are set too tight or too wide. Stop-loss orders are automatic instructions to sell an investment if its price hits a level you choose. They help manage risk, especially for seniors who want to keep their money safe without constantly watching the markets. But setting them correctly is key to avoiding unnecessary losses or big surprises. If your stop-loss is too tight, it means the sell point is very close to the current price. During normal market ups and downs, prices often fluctuate a little. A tight stop might trigger a sale just because of these small moves, even if the overall trend is still upward. This can cause you to sell investments prematurely, missing out on potential gains. Plus, frequent small sales can lead to higher taxes from short-term capital gains, which is not ideal for many seniors. On the other hand, if your stop-loss is too wide, it gives your investments more room to move. This can prevent you from selling during normal market noise, but it also means you might face larger losses if the market drops sharply. When prices fall quickly, your stop-loss might not trigger until after the damage is done, leaving you with a bigger loss than you wanted. This can be stressful, especially if you depend on your investments for income. Choosing the right stop-loss level depends on your comfort with risk and the type of investments you hold. For stable investments like blue-chip stocks or bonds, tighter stops might work well because they don't fluctuate much. For more volatile stocks, wider stops are better to avoid being stopped out during normal swings. It's also smart to review your stop-loss levels regularly, especially after big market moves or changes in your financial situation. Remember, no single setting fits everyone. Some seniors prefer tighter stops for peace of mind, accepting more frequent small losses. Others prefer wider stops to stay invested longer and avoid unnecessary sales. The goal is to find a balance that protects your savings while allowing your investments to grow. Regularly adjusting your stop-loss levels based on market conditions and your personal risk tolerance can help you manage your portfolio more effectively. In the end, stop-loss orders are a helpful tool for risk management, but they need to be set thoughtfully. Too tight, and you risk selling too often. Too wide, and you might face bigger losses. Understanding how market volatility affects your investments and adjusting your stop-loss orders accordingly can keep your portfolio safer and more aligned with your financial goals.